Hello and welcome. Welcome to AYC today. Now, the nifty IT, and there's been plenty of conjecture with regard to what the future of some of these IT companies hold in the new AI world. But essentially, there's one company, or there is at least one fraternity of analysts, which seem to suggest that SaaS will continue to grow unchecked, and that is because you will still require the basic software. And in fact, there will only be an acceleration in the customization of software, given the fact that you have AI and coding can actually help you accelerate the development of software. And therefore, SaaS will likely continue. But here's a stock and here's a story where the stock has fallen over 50% from the highs that it has clocked over maybe the last year and a half or so. You look at the 1 year returns, the 1 month returns, the stock is down 25%. Begs the question as to whether it is as impacted by AI or whether this selling is really being overdone. And that's the question we'll try to explore, and we'll try to get you a perspective from management as to whether that is actually the case and what the impact of that could well be on some of these companies. It'll give us a tilt, a hint towards how AI is disrupting the space and who will be the biggest losers and who will largely be protected as a result of AI. Now, what's interesting is the fact that now this one does 40 to 50% growth, and it guides for that. The aspiration is to get from maybe sub 2,000 crore in terms of top line to 9,000 crore in terms of top line over the next 5 to 7 years. Margins will also expand in the next 5 to 7 years from the current 11% margins or 10%, sub 11% to nearly 15%. So you'll likely see a positive tailwind if obviously all of the other business metrics remain protected. This listed at approximately 165 rupees a piece. It's currently at the lowest PE since its listing. Also, in terms of 1 year forward PE, it trades at 17 times, extremely fast growing, had 2 softwares a couple of years back, now has nearly 10 softwares, which it's cross-sells to existing as well as new customers. And it has beaten all of its growth guidances in the last 2 years. So this is all fact, right? That doesn't change. What really needs to be understood, and whether we can trust management on the fact with regard to their guidance, that AI will likely not disrupt this. And we'll try and get a perspective and get you that perspective as to whether that will happen. In terms of the real concerns, AI, I've spoken extensively about that already. I don't want to overdo it. EBITDA, margins need to start going up, which hasn't happened, likely to happen over the next 5 to 7 years. And the real concern, that is cash flow. Cash flow from operations expected to turn positive in FY27. How much is really the question, and we'll try and get a perspective on all of those from the management as well. How sticky is the business? That will really determine as to how much of a disruption does AI create. We'll try and get all of that as a perspective, but let's step back. Let's get a sense of what the company does. It was incorporated in 2011. It's Hyderabad-based, software-based corporate spends and spending solutions is what it focuses on. Platform for employees as well as vendor-based payments is what it focuses on. Has now diversified into tax and others. So they've got plenty of products. Let's talk about exactly those products. Zaggle Safe, that's the first product they have. It's an employee expense management and benefits expense management platform. It also takes care of employee tax benefits. That's Zaggle Safe. Propel is the rewards platform, the rewards and recognition. And it provides incentives and employee rewards and recognition to employees. Green Edge is the acquisition they made in December 2025 to boost the Propel service offering. That's how it's structured. Zoya is a vendor payments and accounts automation platform. Zaggle Fleet manages logistics, fleet and travel expenses for companies and corporates. Zaggle Zatix empowers business with full control over spends through dashboard and corporates. Zaggle International Payments, which is ZIP, is one of their other products, which is simplifying international payments, right? A complete compliance and transparency over that. And then there's takeovers, like which they've actually taken over, or they've bought some of these companies. Companies like TaxSpanner, which allows them for a management ecosystem for digital tax and accounting services, and Mobileware Technologies, which they invested in March of 2025, which is last year, enhances the fintech infrastructure with UPI, IMPS, and API banking capabilities. Now, you probably this is overwhelming, but think about it from a company or a corporate standpoint. They're virtually trying to cover every single angle of expenses. They started with employees, and now they're diversifying across expenses from logistics and largely employee related, but even into tax. So that's broadly the tilt of the customer or of the service offering that they give. And they have softwares across the board. They create dashboards for those softwares. That's broadly the way in which they play. In terms of customers, they have Honda India, Polycab, Zomato Hyperpure, RCF, IIFL, Tech Mahindra, White Oak, Siemens. So it's a fairly diverse set of customers that they have. They also have partners, because you have to have a seamless transition between customer and partner in terms of payments and payment solutions. So they have HDFC, Kotak, Axis, Yes, and SBI cards. The network is MasterCard, Visa, RuPay also is what they service, and now they've started to cross-sell with some of their clients as well with regard to MasterCard, Visa, and RuPay. And then there are certain other variable additional services which also is something that they sell. Now let's look at the very impressive P&L of this company and how it's grown. And you'll see that the last 3 years, it's grown at a very, very brisk pace. So in terms of top line, it's grown at 52% YOY. The current FY25 top line was around 1,300 crore. They've already beaten that in FY26 in 9 months itself. That's a 52% growth on the top line number itself. EBITDA has grown at a milder pace, 24%. Working capital is some concern with regard to what's really eating into the cash flow. But just in terms of EBITDA as well, margins haven't risen as quickly as one would want, because they are focused on cross-selling, and their expenses are going up disproportionately as they continue to build products, right? And they still have to sell some of those products, which happens with a lag, right? And therefore, your EBITDA margins have compressed a bit. Let's talk about profitability. That's gone up at a 28% CAGR over the last 3 years. Really, but is profitability the key metric? I mean, if I can show 100 crore profit, does that mean that I've got 100 crore rupees of cash? No, right? Cash flow is important, and we'll speak a little bit about that. Before that, let's look at the 9-month numbers, which are extremely impressive. When you're looking at revenue growth, it's at 45% YOY 9 months. EBITDA has grown at 62%, so you're starting to see scale play out here. You've seen margins inch upwards from sub 9% to around 10% now in terms of EBITDA. And you've got profitability which has surged 70% as a result of margin accretion which has happened. Let's talk about the margin trajectory, and you'll see that on your screen. You'll get a perspective. In terms of margins, the margins sank as product portfolio went up dramatically, and thereafter we've seen a slow creep up with regard to margins. These margins are expected to hit 15% maybe over the next 5 to 7 years. That's the long-term guidance given. Now, 5 to 7 years is really long, and we'll try to get something more short-term as we carry this conversation forward. In terms of users, etc., you'll get a plate on your screen which kind of shows you how the user base has grown, and you'll see some sharp growth numbers out there. The customer churn is fairly low in this kind of a business, at least at this point is what they're seeing. In terms of employee count also, in terms of penetration, it's gone up. The banking partners have also gone up, kind of shows the kind of growth clip that they're doing. Now let's look at the balance sheet. And this is where things are very important, because when you have a fast-growing company, you want a decent balance sheet to support that. You've got a book value of around 1,311 crore here. You've got no borrowing on the balance sheet, so no concerns whatsoever. And this is excluding these liabilities, of course. And then you have a cash bank balance of around 550 crore. So they have a war chest in terms of that cash bank balance as well. That's something you want to keep your eye out on. There's a 3,000 crore market cap company having around a 560 crore cash bank balance. So that's something you want to keep an eye out on as well. Let's look at cash flow now. Your cash flow from operations hasn't really come through. A lot of it sits in receivables. As the business has scaled super quickly, a lot of it sits in receivables. That's what the management has said in the past. There will be cash flow break-even, CFO, which is cash flow from operations break-even in FY26. FY27 onwards is when this cash flow starts to translate. So while it's very, very strong growth, and it's understandable, I have unfortunately just been super conservative, and I'm giving this a thumbs down, only from a perspective that it's not converted profitability into cash. But that may well happen, and that may well be the trigger point where investors start looking at this maybe differently. You look at the conversion, it's at 20% for FY25, negative for FY24-23. Your net cash flow nonetheless is at 30 odd crore. When you're looking at thereafter the return ratios, you'll see that the return ratios were fairly elevated in the past. They sank very, very quickly as the product portfolio increased. And at the moment, it's probably at a low point of 13%. We try and understand as to whether ROCE starts to pick up as well, because that's the other concern that investors have. You're sitting on 500 crore of cash, and then you want your ROCE to really pick up thereafter. Look at shareholding. 44% shareholding is held by promoters. DIs have a decent chunk of around 8%. They've in fact increased their holding versus 2 years ago. And FIs have actually reduced their holding on a consistent basis. The public is where the holding has inched up. So that's the way in which this has played out. We've given this a neutral, given the lower than 50% holding by promoters. And we have, in terms of analyst stake, we have 2 buy calls, no holds, no sells, just 2 buy calls. And JM Financial, I believe, is one of them. And what we're seeing in terms of the return potential, over 100%. So that's extremely strong. But just the fact that there are only 2 analysts tracking this one, we've given that neutral from a conservativeness standpoint. Now look at valuations. And we spoke about this for a bit. 16.5 times 1 year forward. The 2-year average is around 45 times. It even listed at a higher valuation than what it is currently trading at. The range is so vast, from 16 to 90, but it's at the lower end of the range. And therefore, I'm forced to give this one a thumbs up. So, of course, a few drags, a few negatives, but there are plenty of positives to look for. Let me bring on board Avinash Godkhindi, who's the Managing Director and CEO at Zaggle, and also part of the promoter group. Avinash, it's always wonderful talking to you. Let me first start off by understanding this entire AI play, right? There's just so much pessimism on companies like you as to whether you will be able to evolve in the fast evolving software landscape. Do you believe you can be replaced? How sticky is your product?
Great question. Thank you for having me on the show. And wonderful coverage. I really loved how you covered the company very comprehensively. So kudos to you for that. The one thing we need to highlight here, right? About 2.25% of our revenues come from software or software fees. The rest is all transactions, right? So that's interchange, that's invoice to banks. Even if you take it on a net basis, net revenue basis, about 4.05% of our revenues come from software. So that's point number 1 on the AI impact. Pure SaaS companies, the story obviously would be different because 100% of the revenue would come from software. In our case, it's 2.25%. So how much disruption could AI bring? You can assess to our business. The other thing, AI actually has turned out to be a big blessing for us. Our customization timelines have gone down dramatically. Our ability to ship code quickly has gone up. A lot of our customers are liking the fact that they are able to not necessarily completely have to redesign all their workflows, but we are able to build capability which sits well with their workflows. So overall, I think if you look at it, the efficiency that it brings internally, as well as the extra ability capability that we are able to offer to our customers, AI has been extremely good. Look, spends have to happen. Companies have to spend money for their employees, for their vendors. And as long as those spends are happening through our ecosystem, we monetize on the spend. Largely, we don't monetize on the software fees in any case, and we've never have. So that's something which I think is very important for us to highlight.
I get your point. So your fee, Avinash, explain this to me better. Only 3% of your top line comes from core software recurring revenue.
Correct.
The balance 97 is linked to spending by clients and other individuals within the client base that you have, and therefore you make a percentage of that number. Is that the right way to think of you?
Absolutely right. So the 2.25 or 3%.
Right? Apologies, but that is still software, right?
That is actually the spends that you do on the card. So a Visa, MasterCard, RuPay card, and it's interchange, and it's a percentage of that interchange that we take from our partner banks. So the spend in any case will have to happen whether there's a human on the other side or there's an AI agent on the other side. The company has to spend, and those spends need to come through our platform because the reasons remain the same. We are deeply integrated with the ERP of the corporate. We are integrated with the bank system on the other side. So the reconciliations become much easier, much more automated. So those reasons continue for for a non-AI world and with an AI world.
Okay, and so yeah, that makes complete sense. So because it's card driven, you also have a physical presence there at your customer base. So there's a physicality to it. Also, on top of it, you're so well integrated with ERP that it's difficult to kind of remove you overnight and replace you with an in-house product if someone is building one. That's the right way to think of it, right, Avinash?
Exactly, and we are connected to the ERP on the one side. We are connected to the bank's systems, the card management systems through APIs on the other side. So even if you're able to create a system which connects beautifully with your ERP, the solution for spend management requires both these parties to be connected. And none of the banks would be comfortable to get directly connected to a AI-driven software of the corporate because they are not going to be able to audit the corporate. Today, all our 19 partner banks audit us. They enforce their security standards on us. They wouldn't be able to do that with partner customers, right? So there is a requirement of an intermediary, and that intermediary in this case is Zaggle, which brings all these pieces together. Companies also work with multiple banks. So if they were to try and integrate with multiple banks, that becomes that much more complicated.
Okay, yeah, I get your point. Now, talk to us about AI. So you're saying that there is going to be a shrinkage in terms of your time or your employees' time spent on coding, right?
Yes.
Does that therefore mean that your EBITDA margins expand quicker than what you were earlier anticipating? Does it mean that you're able to churn out more product? What does it mean? Give us a sense of that.
Yeah. So I'll give you hard data, right? So today, the last analyst call and investor deck, we shared that the number of employees that we have is 325, down from a number of about 400 a few quarters ago, right? So you're seeing that we are able to generate a lot more revenue with a much smaller base of employees. And why is that? It's purely AI or largely AI. AI is allowing us to be able to, ship a lot more at a lot lesser time, it with much greater efficiency, right? So that's the clear impact with data and facts that we are seeing on our business.
Okay, and talk to us therefore about what this does to your margins. You've guided for a 15% EBITDA margin in the next 5 to 7 years. You're currently at 10. You've cut down obviously on employee costs. Give us a sense whether margins therefore go up more dramatically going forward, because I mean the last 8 months was just the trailer. The movie is actually about to start where AI is concerned, and therefore the impact of that on your P&L. Give us a sense. Does it give you confidence to drive up EBITDA margin to 15% in say 3 years instead of 5?
See, the acceleration is likely to happen in terms of EBITDA at a much faster pace than what we had originally anticipated. The other place where we see AI helping us a lot is our pricing power goes up, because if a company wants to deploy an AI solution, what are their options? Are they going to build a full-fledged in-house AI team to be able to develop all this? 9 out of 10 companies won't be able to do that, right? So there are a lot of capabilities, especially on the FinOps side, that we are building, which are state of the art, spectacular, not just from an Indian perspective, from a global perspective, and that allows us to be able to charge a much higher premium as well. So there's the benefit on the cost side. Two, there is the benefit that we hope to see in the coming years on the margin expansion for revenue side. So all in all, we are extremely bullish and chuffed about the impact of AI in our space. And the stickiness, as I mentioned previously, comes from our position where we are a many-to-many connector, many corporates on the one side, many banks on the other side, and we sitting as a intermediary there.
Understood. And an irreplaceable intermediary, right? Is that how you would term yourself, Avinash?
Absolutely.
Okay.
Absolutely.
Okay. So that gives us good clarity. Okay. give us also a sense with regard to your revenue growth trajectory. You've done nearly 50% growth over the last few years. You've done, in fact, 52% last 3 years. And that kind of growth clip continues. But for how long? You've guided for $1 billion revenue, rupee revenue by FY, maybe in the next 5 to 7 years. Do you advance that given AI and given that your product suite will be much wider, much faster now?
See, it's possible. We've said $1 billion, assuming that rupee doesn't go completely, off the charts. So if you look at it safely, say a 9,000 crore kind of number by FY32. Right now, we are sticking to that, but as we see in the next couple of years, the trajectory and the positive impact of AI, we could accelerate that, and that's a definite possibility. Growth obviously comes to us, A, organic, domestic, B, inorganic through the acquisitions, which some of them are doing wonderfully well, like Green Edge and Mobileware, which is an investment, and of course, potential entry into international markets. So there are many levers for growth. And look, today we've just scratched the surface in terms of the opportunity on spend management in India, even though we are a market leader. 30 years ago, ERPs were unknown. 20 years ago, HRMS was unknown. 10 years ago, CRM was unknown. Those are established categories today. In 10 years' time, we strongly believe in India, we will be the market leader, and spend management would be a very well understood category by investors and CFOs. So that's a prime position that we hold today, and we want to be able to take full advantage of that in the coming years.
Right. Avinash, plenty of questions on your cash flow from operations, some of them coming from me. And that'll bring a smile to your face because you'll recall all those questions. But Avinash, tell me, in terms of FY27, your EBITDA will roughly be 200-220 crore odd. If I've done the math right, at you growing at a 40 to 50% kind of clip. So you'll do roughly 220 to 230 crore of EBITDA. How much of that converts to cash?
The EBITDA could be higher depending on what the top line is, because this year itself we would be, in a 180 sort of range potentially, right? But a lot of it should convert. Of course, it's a journey. Improving cash flows is not something which is, a one-shot activity, and we've been working behind the scenes very diligently on that. Look, the broader perspective that we want to share with the market is we were always cash flow positive until our IPO or thereabouts. We raised capital to grow. And we've deployed that capital in the business for growth, right? And that's growth is obviously visible to all. And the next step is to improve the cash flows, and we are committed to that. And we hope to see much better cash flow numbers and EBITDA to cash flow conversion in the coming years.
I'll call that non-committal, Avinash. Of course, EBITDA will improve, but you're not giving me a number on the cash flow. Okay. Now give me a sense, Avinash. You've got 500 crore odd of cash that you sit on. You're a 3,000 crore market cap company. You're obviously doing acquisitions, but you're doing smaller acquisitions. What are you going to do with all this cash? And now you're cash flow positive. You're going to do 100 crore plus of cash flow eventually, likely. What do you do with all this cash?
No, of course, we want to deploy that cash to be able to make smarter, better acquisitions, larger acquisitions, both domestically, globally. But the one thing we are committed to is A, compliance. So acquire companies where the cap table and the compliances are clean and correct. The other, of course, we want to enter into companies where the valuations are reasonable, because it's all great to acquire a company at a very steep valuation, but how do you make sure you're generating returns out of that? So it's taking a little while for us, but we are working diligently. Some of the smaller ones have generated extraordinary returns for us already, like a Green Edge, where we acquired the company for up to 20 crores. We paid 12, and the company is already doing this year revenues around 70 plus crores at an EBITDA of about 7-8 crores. So that's the kind of results that we are seeing. The one or two larger ones that we are exploring, but don't want to talk about them until they close.
Okay. Avinash, we will call you though, and we will have a conversation with you when those close. Completely out of time, unfortunately. This conversation could go on, but viewers, completely out of time. Thank you so much, Avinash, for coming in, speaking with us, giving us that perspective. Thank you so much for tuning in. More action to follow.